Okay, good morning, class. Today we're going to be talking about the risk preference of investors. A risk preference of an investor helps us better decide which kind of investment is suitable for which kind of an investor. So basically, how much risk an investor is willing to take for a given amount of return is basically his risk preference. Now, according to the rule of diminishing marginal utility, as a person gets wealthier and wealthier, he should be taking lesser and lesser risk for the same amount of return. Right? And this makes logical sense as we can see that people, as they mature, they age, they start approaching retirement, they start looking for safer avenues for investment rather than riskier ones. And this is because they have already amassed a great deal of wealth, and that additional wealth does not seem worth the risk that they undertake. Right? So the law of diminishing marginal utility applies to risk, and thereby, logically speaking, in economic terms, a rich investor should be willing to take less risk than a poor investor. But as you would have noticed in the world around you, the world is not perfectly rational, as economics would have us believe. So the world is boundedly irrational. So there are certain limitations of characteristics of nature, personality, of processing power, of time availability, of capability that every individual has, and that is the boundary within which he works. So the real world is more towards a bounded rationality. So investors need not always be willing to take uh, always a rich investor might always not be willing to take lesser risk for the same amount of return. There are basically three categories of the type of investors that we have. The first is a risk-averse investor. Now, you want the highest return for the minimum amount of risk or the minimum risk for the same amount of return, right? A risk-neutral investor will just look at the return and not look at the risk associated with that return, as we used to see with investors before the modern portfolio theory or Markowitz portfolio theory. Risk seeking investor. Now, this is a particular class of investor, and this you would see prominently among the affluent rich angel investors who, despite having a lot of money, are willing to take risk and want they seek the thrill, the chance of they might lose the money or they might earn several times more than what they have invested. So they are called risk-seeking investors. Now, these are the utility curves of different types of investors. A risk seeker's utility will go up as the risk goes up. A risk neutral investor remain a straight line because all he is concerned about is the return from the investment and not the risk associated with that investment. Whereas a risk averse investor will start avoiding that investment or start feeling a sense of dissatisfaction as the risk increases. So basically, your investment decision as to where you should invest or not should not only be based on what kind of returns the portfolio or the product or the security is offering, but also the kind of risk preference do you have. Are you a risk averse investor? Are you a risk seeking investor? Are you a risk neutral investor? If you understand this characteristic about yourself, you can take a lot better decision about where to invest. So the same investment might be suitable for an individual with the same level of income and background, and might not be suitable for another individual for the same level of income and background. Because try and understand this, that everyone's perception towards risk and how much they enjoy the fact that they might not get the returns that they're looking for, might get more than it or less than it, varies. And this is why it becomes very important for certified financial planners to match the investor to an investment vehicle not only based on the returns that he needs, but also the risk that he's willing to take, the risk that he can handle, the risk with which he can stay within the investment portfolio for the investment horizon without having to liquidate an investment just because the investment has gone up or down. That's it for today, class. Thank you.